Welcome back to another weekly episode, guys. So, in the last week's episode, we discussed how you can take action and build wealth in a bear market, and we'll continue that discussion forward. In today's video, I'll be showing you the fundamental aspect of stock picking, and in the next part, that is next week, I'll show you technical aspects in detail. See, one of the biggest mistakes that investors make in a bear market is chasing the hype kind of stocks as opposed to stocks that have solid fundamentals. You got to understand that not all stocks are created equal. Some of the stocks after bear market will recover and soar, whereas the others will crash and burn. And that is what I want to point out, how you can avoid this in your own portfolio. So what I'm going to share in this video is the four metrics that I feel is important to picking right stocks at the end of bear market. See, no way I'm suggesting that these are the only four metrics or data points that are important. These are the data points that have worked for me. And that is what I'm going to explain. So, those data points are sales, profit, return on equity, and debt. In one line, if I have to summarize each, then sales shows the demand and business growth potential. It's extremely vital to understand this. Profit indicates how efficiently a company earns after its expenses. Return on equity, on the other hand, measures how well a company uses shareholder money to generate returns. And debt affects the financial stability. If you have too much of debt, that can be risky. Whereas if you have little to controlled kind of a debt, then that fuels growth for a company. And this is what we are going to explore in detail. The first point that we are going to explore in detail is about sales. And within sales, there are four key data points I like to track. First, year on year growth. Second, the compounded growth over 3 years, 5 years, 7 years. Quarter on quarter growth. And then whether the growth is organic in nature or it is coming through via acquisitions of smaller players within that industry. So, this particular sales analysis that I do, again, it is based on the teachings of William O'Neill. So the first thing I like to track is year on year growth. I compare the current revenue versus last year to see the growth trends. What I look for is consistent double digit growth, somewhere between 18% to 13%. That is what I track. The second point is compounded growth. This actually helps you smooth out long term growth. And a 3 year compounded growth greater than 20 to 25% is a strong sign of sustainable expansion. Quarter on quarter growth, you got to track whether the revenue is accelerating or not. It is a positive sign, of course. But in my book, yearly growth numbers are more important because at times what happens due to seasonality, industry slowdown, or some other reasons, quarterly growth can take a hit. And an investor or a trader could have a really strong company in his hands, but just because of the Q on Q growth numbers, he can end up making a conclusion that there is something wrong or the trajectory of sales is changing. This is why I track yearly growth number, which for me is more important. Now, the source of growth. Whether growth is driven by core business operations. What does it mean? Increased demand, new products, expansion into new markets, whether they are able to capture new audience. This is organic growth. Organic growth is usually more sustainable as compared to growth that is driven by acquisitions. That is, if you're acquiring some smaller players within that industry. It's mainly because core business operation is what gives you the technical know how and it gives you the ability to cut your cost, boost your margins, and use the profits to again invest in that business. So, in my books, as a trader, of course, cash is king, but as an investor, for me, sales is emperor. So let me now show you a template of how this data looks like. So this is a snapshot of a particular company, results from March 2016. Look at the sales. Just look at the numbers. This is a hit mainly due to COVID, but look how strongly this company bounces back in terms of sales. March 2020, 3,485. March 24, 12,375. You look at the sales growth figures, 10 years 20%, 7 years 31%, 5 years 36%, 3 years 68%. Look at the quarter on quarter acceleration, 75%, 46%, 266%, 65%, 53%, 64%, 52, 50, again 51. And June 24, 56%. So these are high double digit growth that you're seeing. And this tells you that this particular company is special. And during market pullback, during a bear market, during massive correction, it is these kind of companies that you have to look into. Now, the next section that we'll discuss is about profitability. So, sales part is over. Now, let's come to the profitability part. Within profitability, the main thing that you have to see is that sales and profit should grow together. In this, I have about 5 key data points I like to track. First is GPM, second is OPM, that is gross profit margin, operating profit margin, net profit margin, that is NPM, expansion, and the overall trend. So, what do I like to see in gross profit margin? And for those of you who are beginners and don't understand what is GPM, OPM, NPM, just use Google. Fundamental analysis is not that difficult. It is relatively easy if you ask these things to Google, and you'll get simple answers, maybe on Wikipedia or any other forum. So, gross profit margin greater than 22-23% usually indicates pricing power and cost efficiency. If gross profit margin is rising along with profit, it's a strong sign. Take a snapshot of all these slides so that you can refer to it when you're analyzing companies. Operating profit margin ideally should be in higher double digits. It measures the efficiency at the operational level. It shows how good the management is in terms of delivering higher double digit numbers. You have to look for companies that are expanding OPM over time. Again, a template I'm going to show you so that you can take a snapshot and get better at this. Net profit margin, it means more profit per rupee of revenue. Again, companies with strong brands, big fan following, they usually have higher net profit margins. And this tells you that a company is not only great in terms of its products, its cost efficiencies, it is cutting costs across its supply chain, and then it is able to sell those products and increase the net profit margin, that is profit per rupee of revenue. And last is expansion. This is what I like to see. Are the margins expanding? Mainly not Q on Q, but I would like to see on yearly basis. If profit is growing but margins are shrinking, it can indicate rising cost, pricing pressure, and poor operational efficiency, which is a large cap player in the paint segment. Despite of its amazing technical know-how, despite of its amazing presence in terms of market share, if you look at the profit margin of that particular company, I know everybody knows which company I'm talking about, you would see a clear decline in margins. And it can be attributed directly to, yes, cost, pricing pressure, and competition also. All right, I hope this part is clear. Now pay attention to the next slide because this can easily be replicated on Excel. The red part you see is revenue, the green part you see is profit, and the yellow part you see is margins. Most of the great companies are going to show sales and profit growing together. If you see profits are rising but revenue is stagnant, then you need to check whether company is into aggressive cost cutting instead of business expansion. You need profits and the margins to expand on back of business strategies and expansion, not on the back of cost cutting. Profit growth should outpace revenue growth. Now ask yourself, why would profit growth outpace revenue growth? It can only happen if a company is becoming more efficient, if the management is learning more about the business, is ahead of the competition. All right, so the thing you have to look for, as an example, let's say revenue is growing at 20%, profit should be growing at 30%. So this is how it should look. That profit should be easily surpassing, maybe in the second year, third year, and then sustaining above the pace at which revenue is growing. Now, as a template, if I want to show you, you look at the compounded sales growth, 10 years, 18%, 5 years, 36%, 3 years, 68%. This is sales growth. Now look at profit growth, 10 years, 59%, 5 years, 57%, 3 years, 101%. I hope this part is clear. Again, look here, sales growth, 10 years, 20%, 7 years, 31%, 5 years, 36%, 3 years, 68%. Look at the OPMs, that is operating profit margin. 10 years, 12%, 7 years, 13%, 5 years, 14%, 3 years, close to 15%. Just ask yourself, the quality of management the grip that they have on their business, because these numbers are staggering and it is very difficult in markets to replicate these numbers. All right. So the next metric that we'll study in detail is what is a good ROE. ROE means return on equity. There are four parts to it. Number one, what is the ideal number? Number two, what are the peers doing? Number three, what is the trend? And number four, and the most important one, what is the quality of ROE? You must have heard many a times that investors or traders should prefer companies with 8 or 12% ROE number, or maybe 16%, 20%, 25%. But actually, the number per se is not important. That is why you need to conduct a ROE analysis. What is the ideal number? A company generating return on equity above 15% is considered efficient. 15%, by the way, is an amazing number. And usually you will see high growth companies such as technology, AI, these companies have a ROE of more than 20%. Whereas stable businesses, utilities, FMCG, consumption, banking, they can sustain ROE somewhere between 8 to 12%. That is why in banking or FMCG, the ROE number will be different as compared to high growth companies. This is why a standalone number is not important on its own. Peers. A company should have ROE higher than the industry average. Let's say there is a stock X. If a stock X has ROE of 18% and the industry and its peers, competitors have a ROE of 13%, then obviously that company should get the preference. If FMCG stock has a return on equity of 18% while the peers, its competitors, have ROE of 10 to 12%, then obviously this FMCG stock is a great company and you have to look at it. Trend. A rising ROE trend shows that the company is improving its efficiency. A declining ROE is a big red flag and you have to investigate that further. What I have seen is most of the great companies that go on to deliver 25% compounded stock market return have a ROE number that is above 15, 18% and trending, rising over a period of time. Or they can even sustain that number for a long duration. The last point is about quality. High ROE should be backed by free cash flow. Now, again, if some of you are beginners who don't understand what cash flow, free cash flow is, just Google about it. These are simple things. Fundamental analysis is simple. It's made to be complicated so that you go to the fund managers, you go to experts to learn about these things. Fundamental analysis is no more hard than something like a technical analysis. It's just that it's made to be a lot more harder than it actually is. I'm talking about common sense fundamental analysis. Now, if a company has high ROE but negative free cash flow, it might be manipulating earnings. So you can easily find whether earnings are being manipulated or not by assessing the quality of ROE. Check if the company is consistently generating cash from operations. That is the core business operations, whether profits are expanding, margins are expanding, new products, new demand, new avenues. All right. Again, this is qualitative research. You don't have to be a math genius to figure out fundamental analysis. This is just common sense approach to fundamental analysis. Now, before we move to the last metric, I'll just spend a couple of minutes more on the quality of ROE aspect because this is more important than a number per se. Now, within the quality of ROE, you need to look for a couple of things. Number one, strong profits. If ROE is increasing due to rising net profit margin, it's a positive sign. Again, everything is linked. That is why these four metrics I've selected. ROE and debt. If a company takes on more debt, ROE may rise artificially. That is why it's important to check for debt to equity ratio, which is our last and fourth metric. One-time gains. You got to check whether ROE is inflated by non-recurring profits. Example, asset sales, tax benefit, etc. If this is why ROE is going up, then it is not a good indicator. Number four, stability. Look for ROE that is stable and growing over multiple years. That is why trend of ROE is more important here. Now let me tell you about the fourth metric, which is debt to equity. This may seem a bit complex. Just give me a couple of minutes. I'll just clear this thing out for you. The first is debt to equity less than 0.5. It means that particular company is a low risk company, especially where interest rate environment is not great for the market. That is, interest rates are high. This indicates a financially stable company with low reliance on debt. This usually is in stable industries such as FMCG, pharma, IT. You'll see such companies have low debt to equity ratio. Debt to equity between 0.5 and 1.5 should be marked as moderate risk. This is acceptable for capital intensive industries, but debt of this magnitude is manageable only if cash flow is strong. That is, cash flow from core business operations. Third, debt to equity greater than 2. This is high risk. This signals excessive debt. Of course, even in this case, if cash flow is super strong, then this number is fine. There are a lot of high growth companies that have debt to equity ratio greater than 1.8. But if the economic downturn happens, or Fed or RBI does not cut rate, it increases rates due to economic uncertainty, then this is what is going to burden the company, and it's going to prevent that company from growing in double digits. Many a times, those companies are also going to turn out to be disasters. That is why debt to equity number remains crucial. You must always compare debt to equity ratio to industry average. Now, different industries, just like ROE, have different debt norms. Example, banks and NBFCs will always have high debt to equity ratio due to the lending business, whereas something like tech firms, pharma will always have a low debt to equity ratio. That is why a number per se cannot be applied. And this is the reason I don't like screeners. Because when you put debt to equity less than 0.5, you will get most of the businesses except high growth businesses, banks, NBFCs, finance companies, just because the debt to equity number you are analyzing without taking into consideration the industry. There are two kinds of debt: good debt and bad debt. Now, good debt is used for expansion, acquisitions, research and development, increasing production. How do you see this? You can easily see it over profit expansion, margin expansion, that is strong cash flow. Such debt is good debt. Now, what about bad debt? If you see debt that is used for covering losses, paying interest, dividends, or inefficient spending, maybe management is splurging money on XYZ things, this is what is bad debt. And usually in the SMID space, you will find a lot of companies doing this. All right. So this is a broad template that I follow for something like debt to equity. Let me now tell you about these four key data points, which I call it spread. Why spread? Because it is sales, profitability, earnings, and debt. So this is what I call as spread. Now, what you have to do on your own is you have to dive deep into each point. Again, use Google. There are a lot of tools these days. You can ask questions, you can get answers. Use such amazing technology that is available to us that was not there about 5 or 10 years back. All right. So in sales, you have to see that sales technically show the demand and business growth potentials. All right. So what you need to see: high sales, high profit, high ROE plus low debt. This is strong financial health. And this is the key to finding some amazing companies. Of course, you have to tinker a bit with debt numbers because a lot of companies won't show up. ROE. ROE measures how well a company uses shareholder money. Low ROE uses, that is, it means inefficient use of capital, even if sales and profit are high. So if you find a company where sales and profits are high, but ROE is not great, you got to investigate further. Profit. Profit indicates how efficiently a company earns after expenses. If you have high sales but low profit, it could mean a lot of leakages. Indirectly, poor cost management. Again, this is critical. Debt. Debt affects the financial stability. Always remember this. But good profit, that is, if you're seeing a company with great profits, great sales, but you have a lot of high debt, it is risky. It is risky, especially if economic environment changes. It is also risky if cash flow drops. That is, some competitor enters. That is, if margins contract. All right. So I hope this part about the spread template that I use is clear. Again, this is not exhaustive. You can have other fundamental data points which are also important. I just use this to shortlist companies that are growing, especially sales, ROE, debt is limited, money is being used to expand business as opposed to acquire companies that are smaller in size. Basically, I'm looking for organic growth. So this is my ID, st_pyi on Instagram. You can DM me if you have something personal that you can't discuss on open channel. Today the comment section is open, so make sure your comments come in today or before the match. That is India New Zealand tomorrow. I'll definitely answer it. And if you decide to share this video, do it with those who are not short-term speculators and who are in the market to learn and improve their decision making process. I thank you again for being here on the weekend. Have a great weekend ahead, guys. Take care, be safe, and I hope India wins tomorrow.